And what do you make specifically of this kind of odd market action today?
Yeah, well, just to zero in on what's taking place in oil, that is all about the forward futures contracts. And we were talking about May oil. And on those contracts, very little trading has taken place, as one of your previous speakers was saying. But I'd like to really point out very few contracts were trading. So what is the situation is right now, holders of those contracts would have to pay someone to take the oil off their hands because there's just no storage available. So we're looking out to the December oil futures contracts and see expectations of $32 per barrel. And I think that's where a lot of producers are looking to hedge their money, their oil. And they typically hedge out 60 to 65% of their volume in various monthly contracts. And that's why you're not seeing a big impact on the the prices of the oil producing stocks because it doesn't have a huge impact on their earnings.
Yeah.
So that's kind of my quick take.
No, that's a great point. I know you're not even looking to the energy sector in particular for investments. I'll come back to some of the places you would be looking. Jeff, I just want to get your thoughts as well on, energy stocks relative to the crude price and the fact that tech is the worst sector today.
Yeah, I guess to focus in on energy, we would just agree that this tends to be more of a shorter-term kind of technical trading issue here, and that, you could see the way the stocks reacted yesterday. They held up just fine. And if you look at credit spreads in the energy sector, they also have remained pretty well contained after blowing out just a little bit. So, not a lot of disruption there. And quite frankly, we don't think this is just a big deal to the market overall. And there are so many other areas to be invested in at this point. Energy is only 2% of the S&P 500.
Wow.
And even within the energy complex, we've been focusing on commodities that are not fossil fuel oriented, but take a look at lithium, look at next era commodities as we move towards electric cars and that kind of stuff.
Sure. And I know that, outside of the energy space as well, some of the names that you're focusing on include Target and Starbucks and more of the consumer sector, Procter & Gamble, like you've talked about. There's plenty of other places to invest. Mariann, you have kind of the same approach here. I look at your names and it's D.R. Horton, Cisco Food Service. I'm curious that you like the small caps here and wonder if you could explain that a little bit.
Yeah, well, the small caps are so undervalued right now, and I think there was a lot of concern going through the worst of the coronavirus numbers, which I believe are behind us now, but going through the worst that these weren't going to survive, the smaller companies, and we saw the government come in and support them. However, if you look at the price-earnings ratio on these companies, and you kind of smooth it over on a 10-year basis, you'll see the valuations are at record lows against bigger caps. So we think the small caps are very, very attractive at this point in time.
Even with their energy exposure?
Even with their energy exposure, I think there's a number of factors that have been in play going against smaller caps for over a year now. And it's really been the technology side of things, just, leading the pack in large size. And so these have been kind of left and, regardless of whichever sector, but looking very, very attractive right now.
Jeff, would you also describe, a day like today as a pause in the overall rally the tech has had? I mean, we've talked about the NASDAQ's leadership. Many of the outperformers are in that basket. You've got Qualcomm, for instance, as one of the names that you like. Are there other tech names on the list?
So, we do like other names. We just recently added to Microsoft. We have Splunk and Salesforce and other software stocks that we think are quite attractive. And quite frankly, we just think the last couple of days are not unexpected at all. After a 2-week run of the market being up 28% in that first phase recovery rally, we really expected some kind of retrenchment. And our view has been, hold your ground and upgrade. This is not the time to be heroic. Have a nice blend of offense and defense, but your incremental trade might be to fade some of these names that have run hard, that are a little lower quality, a little more cyclical and maybe trade up into some higher quality names that also are on sale.
You know, we got to go, but Jeff, I'm still thinking about your stat that the energy sector is just 2% of the S&P 500 right now. What's your bet, that it goes to 0 or 10%?
Well, neither one. I think it would gravitate towards the 10, but maybe 5% is where I think we'd be. So you get a cyclical bounce here.
Yeah.
But it's not a secular growth sector for sure.
Fascinating. These crises always have a way of accelerating the future, so to speak, and you wonder if that's one pocket, especially where that'll take place. Jeff Krumpelman, Mariann Montagne, thank you both. Appreciate it today.
Thank you.